What's up everyone, it's Connie with MoneyVest. So markets here trading pretty much at all-time highs with the S&P 500 on Friday rallying to over 5,300. The Dow Jones first ever close of over 40,000 points, and the NASDAQ here just a little bit shy of 16,700. So as always, if you guys enjoy this video and find it helpful, make sure that you drop a like and don't forget to subscribe to the channel. If you're just joining us for the first time, and the links to our Discord and Patreon is going to be down below. We'd love to have you on board, and we do have that 16% annual discount that's available until the end of this month. You get access to over 50 members-only private videos, including my entire 30 stock shopping list for when the markets are pulling back and seeing a little bit of a dip or a correction. These are the exact 30 stocks that I'm planning to buy with specific buy targets. And of course, we do have the MoneyVest Index as well as a lot of other educational and tutorial videos. You get access to my TradingView charts as well as the Discord channels with trade alerts and trade ideas and options alerts as well. And finally, I do want to mention that individual courses on fundamentals, technical analysis, options trading, as well as psychology of investing and trading and money in markets, 50% off. Coupon code is going to be May50, expires at the end of this month as well. So this right here is the S&P 500, 5,300, very strong rally, new all-time highs as we've already seen day after day. This has been a very good recovery from its lows back on April 20th. So 420 was the last serious buying opportunity when the S&P was just sub 5,000, and since then it has pushed up a little bit over 7%, with the NASDAQ having a very similar trajectory. Of course, it was selling off back in April. It was down to as low as 15,240, and it's rallied a little bit over 9.5%. As you guys know that I did pick up VUG from those levels from April 20th was the exact buy alert that I sent out for all the members, and this has been up a nice 9.3, 9.4%. SMH we also picked up around the same time on April 20th, and from those levels of sub $200, it is up another 16% from those levels. So very nice move to the markets here, back to all-time highs. Now, Kevin O'Leary says the Americans should get used to the idea that the Federal Reserve won't offer reprieve to interest rates in 2024, plus why he says you would be mistaken for thinking otherwise. So Kevin O'Leary's higher for longer prediction, which is shared by many economists in the US, is based on the fact the Federal Reserve has struggled to hit its inflation goals, and consumer prices continue to remain elevated, clocking in at 3.4% annual increase in April, according to the latest CPI data, which was a CPI week. So we broke down the PPI numbers, retail sales, as well as CPI numbers. And that was not the news the Federal Reserve, which is under immense public pressure to loosen monetary policy, wanted to deliver or wanted to hear, basically, that inflation continues to be a little bit more elevated. And there are many factors keeping inflation elevated, from ongoing supply chain issues to international conflict and pent-up consumer demand and economic stimulus from COVID-19 pandemic. And these are not easy issues to get under control. And inflation is not going down anywhere near 2% for a bunch of reasons, and therefore they're not going to cut rates, is what Kevin O'Leary says. Anybody that thinks they're going to cut rates this year will be mistaken. So that is a very bold statement, because even the markets at least is pricing in for one interest rate cut, and Kevin O'Leary here very boldly talking about that the interest rates are not going to get cut even once, and even if you think that, you're mistaken. So we'll talk a little bit more about that, but this right here, of course, is going to be the CPI numbers, which came in, again, somewhat in line with expectations here, very much at 0.3% month-over-month increase. That was a consensus, 3.4% on a year-over-year basis. I've already done a video breaking down the CPI numbers, so make sure that you do check that out. And core CPI, of course, sitting at 0.3% month-over-month increase and 3.6% on a year-over-year basis. Retail sales, on the other hand, came in a little bit shy of expectations, so softer. So that's, again, a little bit more, I would say, good news, because economic growth is starting to slow down a little bit. Unemployment rate did tick higher. Jobless claims are starting to come in a little bit, more on the higher side, and retail sales is also starting to slow down a little bit. All of those are suggestive of this idea that economic growth is indeed slowing down, which is only going to increase the probability of potential rate cuts from the Federal Reserve. And again, we'll find out with time. And PPI numbers, again, came out earlier this week, came in a little bit hotter than what the expectations were, but the markets, of course, trading back higher this week, up back to all-time highs. Now, this right here is something that I wanted to also break down. We're going to come back to this. So the Dow crossed 40,000 for the first time. Should you keep investing in stocks or wait? So stock market highs happen more often than you think, right? So when the stock market is reaching the highest levels in its history, it's natural to think it might not be the best time to invest. After all, aren't you supposed to buy low and sell high? But selling investments or failing to buy even when stocks are near highs can cause you to miss out on years of compounding. And this is from Brenna Saunders at Kansas City area private wealth manager. Says, and I quote, "It is actually very common for the market to reach all-time highs. The S&P 500 has reached thousands of new all-time highs since 1950, according to the data from RBC Global Asset Management. And for our clients, we recommend staying invested in their target allocations." So here's the idea. I couldn't agree more that when you are looking to invest, right, any time is a great time to invest in the markets, right? Because you don't want to get into this idea of trying to time the market and trying to time the lows and trying to time the highs. So what we do here at MoneyVest and what I teach here at MoneyVest is to simply stay invested for the long term. So for example, I myself, I'm mostly invested about 75-80% invested long in the market. And the only time I am more aggressive and dollar cost averaging more aggressively is the time when the markets are selling off and they're pulling back and they're giving us a very, very appealing and attractive risk reward trade-off. That's when I'm actually doubling down more aggressively. However, when the markets are at an all-time high like they are right now, that doesn't necessarily mean that I would start actively selling my positions or I'd be actively getting out of the market in hopes of market pullbacks and corrections. Okay? Because just because the markets are all-time highs doesn't mean that they can't go higher. Just because the markets are lower does not mean that they can't go lower, right? So both things can happen. Markets can keep going all-time highs, hitting all-time highs, becoming more overbought, more overvalued, more expensive. That can continue to happen. And the interesting thing is that happens more than markets becoming cheap and undervalued and people selling out of fear and markets becoming oversold. That also happens, but it happens for a very short period of time. That's why bear markets are lasting much shorter than bull markets. Bull markets last much longer, and economic expansion and growth lasts much longer than economic slowdowns and recessions and depressions and bear markets. So that's why our buying window is much smaller than our holding window. Our holding window is much, much longer because markets can continue to rip higher, but that doesn't necessarily mean that those are great deals. You can still dollar cost average, but I would personally be doing it a little bit more cautiously and not as aggressively. So it doesn't mean that you have to stay out of the market and that you can't buy stocks. It just means that I'm buying more when markets are lower and I'm buying a little bit less when the markets are higher. So I do fully agree with that, but a little bit of tweaking here that I think it's really important to understand. Now, this right here is also another chart that is a very good explanation. So this is going back as far as 1950, right? 69 years all the way through 2019. And what you'll notice is that right now, as of May 2024, the S&P 500 is 0.09% lower than its all-time highs. And what's even more interesting, as I've already quoted in one of my previous videos, and this is actually also part of our MoneyVest index, is the fact that markets below 20% of their all-time highs has only happened 17% of the times in the last 69 years. So if you think about it logically, right, this is again very good statistic to remember that if the markets are down over 20% from all-time highs, and that has only happened about 17% of the times, that is a very, very good signal that this is a very rare event. This is a very rare occurrence in the market. And that means 83% of the times, 83% of the times markets are within 20% of their all-time highs, and even more, 49%, a whopping 49. So half the time in the last 69 years, markets were within 5% of their all-time highs. So those are some very, very staggering numbers, and just goes to show that staying invested definitely does pay out over the long term. And here's another statistic for you, that over a 15-year time horizon in the S&P 500, the probability of you losing money over a 15-year time horizon for investing in the S&P 500 is nearly zero. 99.8% probability that you actually make a profit if you are invested for at least 15 years or more in the S&P 500. So again, very, very strong statistics suggesting the idea that the markets are strong. Of course, stonks only go higher, and there are hitting new all-time highs more often than we think. But that doesn't take away from the fact that we need to still be cautious, still be alert, and wait for better opportunities and better risk rewards so that we can dollar cost average a little bit further. So markets overall pushing higher. Nvidia was down almost 2%. Nvidia does report earnings next week, so that is going to be very, very important. I'll actually do a video on Nvidia here We got, again, most sectors pushing higher, like materials, energy, financials, communication services. Then we did have utilities, technology selling off. And in the last 1 week, again, all sectors are green. In the last 1 month, also, all sectors are pushing higher. This right here is a very split performance with silver, orange juice, platinum, coffee, copper prices, natural gas, everything pushing higher, with oats, lean hogs, rough rice, wheat pulling back. And then Bitcoin here just a little bit over 67,000, with Ether just over 3,100 as well. So coming back over to the S&P and the NASDAQ here. So this right here is the 30-minute time frame chart that we've already discussed. A very strong support that's going to be sitting roughly at around 52.67, 52.50s. That's going to be inside this green rectangle for S&P 500, and of course all the way down to as low as 52.20. Another support level to watch for S&P 500, down to as low as 51.65 for the S&P as well. Very nice consistent uptrend of higher highs and higher lows, and of course then breaking out and then coming back down to validate that support for the S&P. So again, congratulations to everyone in our community. Again, markets all-time highs, and that's exactly what we wanted to see. It's kind of funny, it's interesting, because back in 2022 when the markets were selling off, I asked everyone a very simple question: when do you see the markets hitting new all-time highs? And very few people could have guessed 2024. I think a lot of people were expecting a lost decade. People were expecting 2025 or beyond. Interest rates are going to stay higher. They're going to keep going higher. Inflation is going to be higher, and markets are just going to be in complete distress here, and we're never going to see all-time highs for a very long time. And fast forward a year, actually 2023 I think might have been the year when we actually did hit new all-time highs for actually NASDAQ. 2024, yeah, so 2023 I think the NASDAQ already did hit a new all-time high. It was in 2024, I believe. So if you come over to the daily chart very quickly, just going to take a quick look here. When exactly did we hit a new all-time high? And it was right around this time. So it might have been actually February of 2024. So it actually was 2024 when we did hit a new all-time high for the market. So nonetheless, I mean, we did that in 2 years, and that just goes to show how strong the markets continue to be in the US. But I would also add, again, it's not so simple. It's not so black and white. There's always gray areas, and the idea here is that a lot of the US economy that is showing a lot of strong growth and earnings growth is somewhat backed by credit card debt. And credit card debt, consumer spending, just taking on too much debt, has been astronomical, and we're now seeing levels that we haven't seen in a very, very long time. So those are some things to keep in mind, because eventually we're just kicking the can down the road, and if that actually does end up being a problem, well, we just got to be careful with what ends up happening in the US with respect to individual stocks as well. So coming over to volatility, continues to sell off. We are now at 11.98. You know what, guys? I gotta take a look at where we are with our volatility reader here. So in terms of where we are with the VIX, so we're just gonna take a quick look here, and we're probably gonna be in about 12 to 10 percentile in the VIX. So there we go. So we're in 9.27 percentile. This is actually quite crazy, because the volatility here at under 12 is at 9.27 percentile here. Extremely, extremely rare to see the VIX this low. And then if you come over to this, total observations, the moment it drops below 10, that's only happened less than 1% of the time. So you just got to be super careful with where the volatility is. And like I said, under 12 will quite be very, very interesting with a 9.27 percentile for the volatility at the moment. So we're very, very low here. And it's about any time we could see a pretty decent spike here in the volatility. In fact, we haven't seen levels like these since December of 2023. If we crack below 11.8, then we're probably going back a very long time before we see the volatility this low. If you come over to the weekly chart, I just want to see when was the last time we actually dipped below 11. I think it's been a long time. I think it's been a very, very long time. So the last time would be about December 2019. It was right before COVID. It was right, actually, yeah. It was right before COVID. That was right before the pandemic spike here in volatility, and of course the crash of March of 2020, when the VIX was down at under 11.8. So we are pretty much heading down to those levels, and just got to be super careful and very, very cautious here moving forward. Talking about crude oil, and crude oil here continues to slide sideways. We are seeing a lot of consolidation here for crude oil at a little bit under $80 per barrel, and resistance is going to stay put at 81 all the way up to $83 a barrel for crude oil. And again, a lot of support and a lot of demand here in this range, in this level here for crude oil, sitting roughly at $72, $73 a barrel for crude. And again, it plays a very significant role in overall inflation prices, And that's exactly what we have to pay attention to, right? Because inflation is going to be directly, affected by where crude oil goes, right? Because that's going to be affecting oil prices, and that's going to be affecting a lot of other consumer items indirectly as well. And then finally coming over to Bitcoin and Ether. And Bitcoin here starting to see a little bit of upside. 67,000 is where we're at, validating that support and then pushing back up. And we got a little bit of a near-term resistance to watch right over here at 67,000. And that's going to be a level to keep in mind. Right now, we're kind of testing that resistance. Support level is going to stay put at $61,000, $62,000 for BTC. And for Ether, of course, we're seeing a lot of consolidation sideways for Ether as well. Starting to see a little bit of that momentum back higher, and resistance is going to be all the way up over here at 3,335 or 3,350, 3,330 for Ether. And support level is going to stay put roughly around 2,900 for this crypto as well. So what I'm going to do is I'm going to keep this video to this brief market update. I'm going to be doing another separate video for all the technical analysis, updated technical analysis on all the Magnificent Seven, big tech, and of course a lot of other stocks that we usually cover in our market update. So as always, if you enjoyed this video, find it helpful, make sure that you drop a like. I'm kind of still surprised and really shocked to see this 11.99 reading on the volatility with this, which is a 9.27 percentile for the VIX, which is a really, really rare event. And you just got to be super careful because we're coming down to levels that we haven't seen since before the March crash here in the volatility. So hope you all enjoyed this video, found it helpful. Make sure that you drop a like and don't forget to subscribe to the channel. Again, links to our Discord and Patreon is going to be down below if you want to join, get access to all the alerts, trade ideas, and again, our buy targets, our members only videos, our individual shopping list, as well as individual courses. Currently 50% off. Coupon code is going to be May 50, and we'd love to have you on board. If you have any questions, please feel free to reach out. And as always, happy investing, and I'll see you all in the next video.